Ryan McDonell, who's our tax manager, up to go through the updates on taxes. Obviously, everything's preliminary with what's going on out there, but hopefully it'll give you some indication of what should be coming or what might happen. So.
All right, I think we're good to go. Good late morning, everybody. Got the tax update. Try to keep it exciting and relevant for you. Going to be going over the Build Back Better Act, the House Ways and Means approved proposals. So just to step back on where tax proposals, tax changes stand right now, without getting into the political side of it. Basically, there's the Democrats control the House, Senate, and the presidency. So they're trying to push through a large bill. You might have heard, 3.5 trillion or 5 trillion or $0 because it's going to be totally covered. That large bill is what's going to contain the bulk of the tax proposals that we're talking about today. That right now is kind of stalled out because they're within that party. There's the progressive side, the moderate side. They're trying to decide what price point do they want to go with. Do they want this to be permanent changes, or is it only going to be a 5-year change? What can we pull out, put in? So they're working through that right now. What we're going to be looking at today is what all the articles are out about. The Tax Writing Committee in the House had approved a set of proposals. The House itself hasn't voted on it, but that writing committee has, and it's made it through that point. So there's still the opportunity for the Senate side to change a lot of these. I would expect that, even if some of the way that these proposals work stays the same, the numbers would change. But this is a good idea as to what direction we're going in, which in general is increased rates for a lot of the items. So that's kind of where it stands. We'd probably see as early as the end of October, we'd start to see some voting, but because of the way things have been going now, I'm thinking it'll probably be closer towards the end of the year, probably right around the holiday, so that they can get something for the break. Then we'll briefly touch on the employee retention credit. If you haven't already talked to your accountant on it or been approached by one of the credit companies, just to touch on what that credit's about. Inventory, everybody's, great sales, but hard to replace the cars. If you're under a LIFO inventory system, like most dealers are, this could cause a large pickup of income if you don't make any changes or if there's no relief offered. And then we're in Mass, so a little bit of a Mass update as well. So on the tax proposals, individual income tax rate, so the top tax rate you'd pay on your 1040, on your ordinary income, wages or income pass-through from a K-1. Right now, the top rate is 37%. That was reduced under the Tax Cuts and Jobs Act back in 2017, and that was set to go back up to 39.6 in 2026. The proposal would accelerate that, put the top rate at 39.6 starting in 2022. You'll notice for most of these, it's going to be a 2022 effective, which is nice. It'll give at least a little bit of time for planning on those items. And then in addition to increasing the rate, they're also going to, you'll hit that top rate earlier. So you could see under the current brackets, if you're a married joint, you wouldn't hit that 37% until you're at $646,000. However, under the new brackets, you would get to that top 39.6 at $450,000. So not only is it an actual rate increase, but it would accelerate when you would hit that top bracket. Cap gains rate, I know this is a popular one. There have been a couple proposals that have been around. Much earlier in the year, there was a proposal discussing, once your taxable income hit over $1 million, then all of your long-term cap gains would be taxed ordinary around 40%. As of now, that proposal is currently off the table. What they're working with at this time is just increasing the top bracket from 20% to 25%. So the way the cap gains work presently, it's a progressive system, so there's 0% for, let's say if you're filing jointly, married joint, the first 80,000, you're at a 0% cap gain bracket. And then for the next, that 80 all the way up to 500,000, you're at 15%. And then anything over that, you'd be at a long-term cap gain rate of 20% under the current system. So that progressive system would stay, but the top rate would change from 20 to 25. And another piece to consider too is when you're kind of filling up those buckets to see which long-term cap gain rate you end up in, you also have to fill that up with, first, other ordinary income. So if you had wage income or if you have income coming out from your K1, that'll fill up the bucket faster so that, if you had over $100,000 of other types of income, you may have no cap gains at 0%. You may end up with a mix of 15 and 20%. Or if you have a lot of income coming through, all the cap gains may end up at the top bracket. So that's generally how those work. The timing on this, as of now, as it's written in the proposal, is from date of announcement. So this proposal was announced back September 13th. So long-term cap gains after that date would be subject to this 25% top bracket. There is some language where if you have a bona fide written contract, signed agreement, so if maybe you were, back in August, you committed, there's a signed agreement for a sale, that would get grandfathered in with the older 20% rate. Otherwise, if it's a sale after September 13th, you're in at the 25%. So this is one of the few items that is, there'd be a portion of 2021 that you'd be subject to this change. What they would change in 2022 is, so the brackets at which you would hit that top rate will align with the brackets on the previous slide. So basically you would get to that top bracket, the top 25%, sooner than under the current system. There's a new item. It would be a 3% surcharge tax. If you have AGI, adjusted gross income, over $5 million, there would be a 3% tax on that. Right now, it seems, as it's written, it seems pretty straightforward that that's, over the 5, you're subject to that 3% on everything over that. And then estates trust, if you have a taxable, that level is lower at 100,000. Net investment income tax. So this one, so a lot of the times if you're discussing cap gains, you might hear, the top one isn't really 20%, it's 23.8%. What that is that 3.8% tax is this net investment income tax. So items such as interest, dividends, investment stock sales, that kind of thing. And then if you have any passive businesses you're invested in, so say, you get a K1 from a business, but you're not really involved in it. Maybe you have a small percentage. You just passively, you get that income. That income is traditionally subject to this 3.8% tax if you make around $250,000. However, income that comes from, if you own the dealership, you operate the dealership, the income from that, or the income that would come off if you have the property held in a separate rental entity, or if you eventually, sell the dealership and that property, all of those typically escape this net investment income tax because you, what they call, materially participate in that activity. What they want to change here is they want to pull that type of income in to be subject to this 3.8%. So then the income that you're getting off the K1, the sale of the dealership, the property, it would phase in for taxable income over $500,000. That income would start to be subject to this 3.8% tax. So now, building on these last couple slides, right? So you'd be looking at 25%. If you're in really high income, possibly another 3%, plus another 3.8%. So when it comes to planning, you have to kind of look at, which ones of these are you going to be falling into. This one, again, would be effective for 22, so it wouldn't be 21 at this time, which would give some time to plan on this. But I think the big point here is they're trying to either, if you're in a partnership, you're usually subject to self-employment tax, and they're trying to even scale here where, S corporations, typically, you get a W-2 for a certain amount, and then the rest of that income avoids the payroll taxes, with the exception of a little bit of Medicare. This is kind of pulling in that income to be subject to this additional tax. QBI deduction, so this was the 20% deduction. This came about as part of the Tax Cuts and Jobs Act. When they decreased the corporate tax rate, they wanted to kind of, provide some equity for the pass-through owners, partnerships, S corporations. So you were able to take a deduction of 20% of qualified business income. If you are a high-income taxpayer, then subject to certain limits where your deduction was based on how much wages you paid or how much property you had. And then certain other types of businesses, like consulting businesses, would lose the deduction over time. Right now, there's a couple of different proposals. The proposal that was in this committee was one to just cap the deduction. So, for example, 500,000 married joint. So I think that's what, 20% of 2.5 million. So if you had qualified business income in excess of that 2.5, you wouldn't get a 20% deduction on the rest of that income. So this is something where they set a hard cap at the amount that you can take the 20% deduction on. That being said, if you've had, say maybe 21 is going to be a really strong year, but maybe in the last few years you were spitting out some losses, any of those accumulated losses as it relates to this deduction will kind of offset against your profitable years. So it may be something where, if maybe the last year, at least on the books, you had a loss, and then this year you have some income, it still may kind of, wash you into an area where you're still getting a full deduction. It's kind of an item where you have to look at the actual numbers. I know I'm kind of repeating, case by case, plan it out, but you might lose a little bit of a QBI deduction here. For the next two slides, so estate planning, it's not my huge cup of tea, but there are some items on here. So the lifetime exclusion for estate and gift tax, that was in the Tax Cuts Jobs Act, that was raised from a base exemption of $5 million up to $10 million, and that was set to expire back down in 2026. Again, they'd be accelerating that to happen in 2022. Now, what this is so say you can make a gift each year up to $15,000, no impact. If you go past that, you start to eat into your lifetime exclusion. So, say you made an additional $2 million in gifts during the year, and you've never used any of your exclusion. $2 million would eat off of that $11.7 million exclusion currently available, and now you would have 9.7 left to take additional gifts. Or when if you pass away, your estate, if it's in excess of this exclusion, it would be subject to tax. Basically what this is doing is it's lowering the threshold so that the amount of gifts that you can make in your lifetime without being subject to tax, or the assets that you hold at death subject to tax, they're taking another 5,000 exclusion off of that. So if you have some exclusion available now, where you can make additional gifts before the end of this year while the increased 11.7 exclusion is still available, there will not be any clawback on that. Meaning, if you eat into the 11.7 by 2 million and then they revert it back down to 5 million or so, you'll get to keep kind of that 2 million that you had in the upper increased limitation. It's basically something, again, where you want to look at if you can make additional gifts, if you want to make those while you have that extra capacity to do so. Grantor Trusts. On this one, at a high level, Grantor Trust, it's an estate planning technique. In a revocable trust, it's typically the assets that are held in a Grantor Trust like this or would be outside of your estate, so it wouldn't be subject to that estate tax. Whoever the grantor is would continue to pick up. You might have part of the dealership is held in a Grantor Trust, so you pick up the income, you pay the tax on it, but the beneficiary is someone else, and those assets, that value would be outside of your estate. They want to change that so the value of the assets held in the Grantor Trust would be part of your estate. so that you wouldn't be able to to get that out from being taxed at death. And there's some other pieces to it as well. Right now, as it's written, it looks like this would be a prospective change. So if you have existing trusts, at least from the perspective of keeping that out of your estate, that it should stay that way. We'll have to see how the final law comes out, if that stays the same. But certain things such as, if you had I think it's an ILA, if you have a life insurance and you're paying in so that you can pay the premiums, items like that you may have to evaluate after the tax law is finalized to see if any of these things are going to cause tax implications for you. We may see a shift away from grantor trusts into other trusts that pay tax at the trust level, for example, instead of just picking it up on your personal return. This would be something, again, after the change actually gets finalized, if you have an estate plan already in place, or if you're thinking of making one, it's something to look into. C corporation tax rate. Most dealers here probably are going through a pass-through entity, so this likely won't apply, but you'll hear it on the news and everything. C corporations are the ones, they pay tax at the entity level, whereas the S corporations and partnerships, the income flows down to you and you pay it on your 1040. The C corp rate is going to go from a flat 21 to a graduated system with the top rate of 26.5%. For the low income side, they are given an 18% decreased rate on income up to $400,000. There's a proposal currently for a tax-free reorganization of S corporations to be a partnership. So typically, if you were to reorganize your entity, if your dealership was an S corp and you wanted to convert to a partnership for whatever reason, that would typically be a taxable transaction. It would be as if it were a taxable liquidation of the S corp, the assets coming out at fair market value, subject to tax on that. There's a proposal in here where if your entity has been an S corporation since before it's May 13th, 96, there was a tax thing that came out back then. If it's been an S corporation since then and all the way up to the point of this enactment, that you could do a tax-free reorganization as a partnership. Why you would do this? If maybe you had appreciated assets within the dealership that you wanted to take out, if S corps have to do equal distributions and equal income allocations, a partnership, you can kind of modify that. You can do unequal distributions, and you can specially allocate the income. And then on the Massachusetts side, there's the sting tax. So there could be possible opportunities of switching to a partnership. It's, again, another case by case to look first to see if you'd qualify under those rules, and then second, if there would be enough of an opportunity to do that. This would be effective for 2022 and 2023. So once it passes, you'd have about 2 years to decide whether there's something you'd want to take advantage of if it did yield any benefit for you. Plug-in electric drive vehicle credit. So this is the typical up to $7,500 credit. Different vehicles by manufacturer are limited presently to 200,000 vehicles. After enough credit's been claimed, the manufacturer, the credit doesn't exist for that type of auto. They'd be expanding this credit. So the base credit would still stay at $7,500. There would be an extra $4,500 and another $500, so essentially another $5,000 for vehicles, batteries manufactured in the U.S., and for the vehicles in particular, it would be under like union labor agreements. I think the whole idea here is they're trying to provide incentive for domestic manufacturing of certain items that would provide an extra increased credit up to $12,500. It removes the manufacturer limit, so that wouldn't be an item. One thing here is the credit could be transferred from the purchaser to the dealer. Now, the way it's written, I've trying to do the math out. I don't think there would be necessarily any tax benefit for a dealer because when you transfer it, you would have to buy the credit off the customer. I think the idea here is instead of the customer getting the vehicle, claiming the credit on their tax return, I think the idea here is customer would buy the vehicle, you pay them to buy out the credit, and then you claim that credit on the entity return. I think it would just be kind of an incentive to be like, we can give you this $12,500 or this $7,500 right when you buy the vehicle, kind of thing. So they would have this opportunity to transfer or buy the credit, and then they would track this. The VIN number would be required to be included on the tax return for whoever does claim the credit. That's how they would trace it. Currently, that's just on new vehicles. There'll be a previously owned electric vehicle credit, similar, for less money, and it phases out a little bit earlier. Again, the VIN number would have to be reported. There's not too much on this, but there's a qualified commercial electric vehicle credit. So typically we just think of, an individual coming in, buying a car, they would qualify. It looks like they're trying to allow business use vehicles to also qualify for this credit, up to 30% of the basis. Again, there's not too much info on this one yet. Alternative refueling property credit. So here, think the electric charging stations, for example. So right now, the electric charging station credit expires at the end of 2021. You can take a credit equal to 30% of the cost, up to $30,000. They're going to change that where they potentially reduce the rate of the credit, but increase the ceiling for how much of a credit you could take from $30,000 to $100,000. So this would be something where if you're buying multiple charging stations, even at 6%, you might be able to get over that 30,000 credit limit and into the 100. Basically, the thing to think here is I know a few dealers have been considering purchasing these towards the end of this year because it's set to expire at the end of 2021. Whether they just do an extension of the credit for 10 years or if they change the way the credit would function, the amount of credit you can take, it looks like there'll be some type of either extension or expansion of this. So it is something where I think maybe if you're buying just one, you could look at still doing this for 2021. But if you're looking at purchasing multiple, it might be worth waiting throughout the end of the year to see where this lands and see if you can get a bigger credit by pushing that project out into 2022. Right. So that's the tax reform info. Employee retention tax credit. For those that don't know, payroll tax credit introduced as part of the CARES Act during the pandemic. It was expanded and changed over the course of other legislation after that point. It originally was not available for people that had PPP loans until December of 2020 is when that changed. So when this first came out, there wasn't a lot of talk about it because PPP was at least upfront, a more clear benefit of getting more money. To qualify for this credit, you would have to show, so there's two ways. Either you show for 2020 a decline in your gross receipts on a quarterly basis of more than 50% when looking at your 2020 receipts versus your 2019. So if 2020 receipts went down by 50% or more over 2019, then you would qualify there. For 2021, it's a little easier to hit. It would be a 20% drop. So you would look at 2021 receipts versus 2019 receipts, see if you had a 20% or more drop, and then you would qualify for the credit. So this may even be something where, sure, maybe this year sales have been good, but if we reach a point, maybe in Q3, towards the end of the year, if there were issues with getting inventory that caused, just because you didn't have the cars to sell, that causes receipts to go down, that could potentially qualify you for a quarter. The other side of it is, so that's more of an objective test. You look at the numbers to see if you met it. The other side is whether or not there's been a government order that has caused a partial or full suspension of business. This would be something where we were most comfortable. Back at the beginning of the pandemic, Governor Baker in Massachusetts had said, essential businesses stay open, non-essential businesses must close. So sales rooms had to close, even though parts and repair might have been open. That caused at least a partial suspension of operations. So during that time that the order was in place, this would qualify you to take the credit. Some of the credit companies are currently relying, they're saying, OSHA, CDC guidelines, those affect the whole country. They're still ongoing. So essentially, everybody's still affected under a government order, and you could potentially get the credit for all of 20 and all of 2021. That's something you have to kind of, measure the risk on that, discuss with your advisors. It's a little bit, I wouldn't say it's a wrong approach. It certainly seems like an aggressive approach. Again, it's something to discuss with your advisor. This is what a lot of the credit companies, they'll approach you and say, you can get up to $33,000 credit per employee between 2020 and 2021. That's what the idea is there, is they're saying, these national guidelines are kind of setting a precedent for you to be able to take the credit. The amount of the credit where they're getting that 33,000 number is you can take a credit of up to 5,000 per employee during 2020, and then up to 7,000 per quarter in 2021. So that'd be 28,000 plus 5,000, 33. So that's where they get that number from. You can't double dip on this credit with PPP. So if you had a PPP loan in the middle of 21, you're trying to take that credit. Usually there's actually enough wages because you get a 24-week PPP period. Usually there's enough wages where you can maximize both the employee retention credit and the loan, but it's kind of an interplay analysis that we'd have to look at. The employee retention credit is a taxable credit, so it reduces your wage expense. So, assuming a top bracket of 40% plus some state tax, whatever benefit or refund you get from the employee retention credit, you're only really looking at a 60% benefit. But it is still, if it is something you truly do qualify for, it can be a sizable amount. It's claimed on the 941 payroll filings, or if that's already been filed for a certain quarter, you can do that on an amended filing. The IRS backlog is still pretty bad. I can tell you from us, even just trying to contact the IRS, I think they have something like a 2% answer rate or something like that on the phones for the individual support. So there's a backlog of hundreds of thousands of 941s. So we're seeing right now at least a 6-month turnaround on paper filings. You do have up to 3 years at least to amend the payroll filing. So if it's not something you did right when the payroll filing went through, it's something we can revisit and see if you can claim the credit afterwards. LIFO pandemic inventory relief. So this year, so again, at a high level, most dealers are under the LIFO method of inventory, last in, first out, and that's just a way of measuring the cost of the inventory that goes against when you make a sale of the inventory. Typically, when you're able to replace that inventory during the year, it wouldn't cause any issues, but as we're seeing, difficulties getting the vehicles, this is causing, almost like a liquidation of the inventory and those different inventory layers. And because of that, that could cause huge kind of phantom income where you'd be picking up sales against very low valued inventory. What NADA has requested relief for, and our national CPA, AICPA organization has requested relief under Code Section 473, which would apply to qualified inventory interruptions. Basically, under that code section, if the IRS would agree and they would come out and announce, say, because of international supply chain interruptions, there's been a qualified inventory interruption. And if you can replace your inventory over the next 3 years, then you will not have to pick up the income for that depletion of your inventory right away. So right now, it's just been letter requests. Again, our National Society has sent a couple examples and letters. NADA has sent a letter. So we're starting to see a little bit more in the media about, in particular cars. It's hard to find a car. Oh, there might be, rubber and tire shortages or parts. I think as this kind of enters more of the public conversation, that might move the needle to see if we can actually get some relief under this 473 before 2021 returns have to be filed in the first quarter of next year. And then if that doesn't end up happening, I know there have been discussions of, potentially electing off of LIFO, picking up the income over a 4-year period. I would say, at least monitor through the end of this year to see if we can get this 473 relief. it would be particularly helpful because otherwise you'd be picking up a lot of income just because, you know, we've been unable to replenish these inventory levels. And then last, on Massachusetts, there's a new pass-through entity tax option. So what this is and you might hear even on the discussion on the national tax proposal bill, the SALT cap. What that is there's an itemized deduction that lets you take a deduction for any state taxes you pay, whether that's state taxes you pay through your W-2 or on your personal return, those state taxes you pay, for example. They capped that under the Tax Cuts and Jobs Act in 2017 to $10,000. As a result, if you were paying more state taxes than that, you weren't getting any benefit for it. You were phased out from it, or it capped from it. As an alternative to this, a lot of states, now it's somewhere around 20 or so, have come up with a system where instead of the income just being taxed, you know, you get your K-1 and the income is taxed on your 1040, they apply a tax at the entity level when the entity files its own return, so that the entity can deduct that state tax without being subject to this $10,000 limitation. So it basically gives you, it's a workaround that the IRS has approved to allow you to get a full state tax deduction. Massachusetts has just recently enacted this. It'll be effective for 2021. It's another case by case to see if it's worth it, but generally this would allow you to take more of a state tax deduction instead of getting hit by that SALT cap. The other side of it though is, like some other states, Massachusetts kind of has this automatic trigger in there where if under the negotiations for the federal bill, they repeal that SALT cap, then this kind of new scheme for the pass-through entities would no longer apply. At that point, you wouldn't necessarily need it to apply because then you can take the deduction on your personal return, but it is something that going into planning season, you may be better off doing it under this regimen. And then you would get a credit, so the tax that the entity paid, you would get a credit that flows down your individual return so that you're not essentially, you know, double paying on that tax. You still get a deduction. And then last, just a few other items. Technically, PPP loans forgiven in 2021 technically aren't tax-free for Massachusetts yet. There's been legislation that's been moving through. Our Massachusetts chapter, the CPA organization, has been advocating for that. They seem confident that that will get passed through. Right now, it's only applicable for 2020, but they are working to make sure that gets finalized for 2021. The millionaire's tax proposal is going to be on the 2022 ballot, which would put a 4% surtax on top of the 5% mass rate if you have income exceeding $1 million. There was a sales tax, a Mass Department of Revenue sales tax requirement in 2022, where you'd have to break out in-store versus online sales. They're no longer doing that. They've taken that off the table. They had a lot of bad feedback there. It's at least temporarily been withdrawn. And then non-resident employees, this was something where if you had someone that, you know, lived in another state but commuted into a Mass office during the pandemic, even if they were working in the other state, you had to consider them still working from a Mass office. That was because of the COVID. There was a temporary procedure put in place. That's been reversed, and now you source their income based on where they're actually working, whether they're actually in Mass or if they're working in a different remote, you know, outside of state location, for example. All right, that's what I've got there. Any questions on any of this info? All right, clear as mud, right? So again, this will. Oh. Yeah, so I think I just know that it has, within the 3 years, you have to replace the full inventory. I'm not sure if it's something where, you know, in the first year, 33% of that has to be replaced kind of thing. I know the AICPA has some examples on that, so we could probably check into it to see what they're looking for.
Most dealers were down 89% of our inventory, so it's a big number.
Right, yeah. Absolutely, right. So that's where, you know, I really think they need to provide some type of relief on that, yeah. Otherwise, just, you know, monitor through the end of the year, see where everything lands. There's kind of the landscape as it stands, and feel free to reach out if you get any questions. Thanks.